Before we begin, a quick and important disclaimer. The following content is intended strictly for educational and entertainment purposes only. It does not constitute professional legal, financial, or insurance advice. Financial products, especially those involving complex contractual obligations such as divorce insurance, carry significant nuances and vary widely by jurisdiction and specific policy language. Laws regarding marital property, alimony, and insurance regulation have evolved significantly since the 2000s. Viewers are strongly encouraged to consult with qualified attorneys and licensed financial advisors regarding their own personal circumstances, and to conduct their own thorough due diligence before making any decisions based on historical financial concepts or products. The year is 2002. A couple stands in a courtroom in a mid-sized American city. They have spent the last decade building a life, a portfolio, and a shared identity. Suddenly, that decade of cooperation is being dismantled by a decree. In the United States, divorce is not just a social event. It is one of the most significant financial transactions an individual will ever undergo. It represents the involuntary liquidation of a partnership, often under conditions of extreme duress. Now, imagine if you could have hedged that risk. Imagine if, back when the honeymoon phase was still in full effect, you could have purchased a policy that protected your net worth against the volatility of your own marriage. It sounds like a cynical construct of a dystopian novel, but in the early 2000s, this was the legitimate, albeit niche, frontier of the insurance industry. Why does this matter to you today? We live in an era where financial technology, or fintech, has democratized access to hedging tools that were previously reserved for institutional investors or the ultra-wealthy. Yet, we often ignore the structural risks embedded in our personal lives. By examining the rise, the fall, and the inherent structural flaws of divorce insurance in the 2000s, we are not just looking at a historical curiosity. We are exploring the fundamental challenge of insuring the intangible, the unpredictable, and the deeply personal. If you understand why this industry attempted to exist and why it struggled to gain mass market adoption, you will gain a profound insight into how risk assessment, contract law, and financial innovation intersect. This masterclass is designed to pull back the curtain on the mechanics of emotional and financial risk management, providing you with a framework to evaluate the risks in your own life today. To understand the 2000s, we have to look at the atmosphere of the time. The dot-com bubble had burst, leaving investors and consumers searching for security. The market was flooded with exotic financial instruments. It was a period defined by the securitization of everything. If you could model it, you could insure it. Or so the theory went. Companies like divorce insurance and various boutique underwriters saw an opportunity in the growing divorce rate in the United States. According to data from the Centers for Disease Control and Prevention at the time, marriage and divorce rates were stabilized, but the financial stakes of divorce had skyrocketed. As dual-income households became the standard and home equity became the primary vehicle for middle-class wealth, the cost of divorce expanded beyond simple attorney fees. It now involved the division of 401k plans, complex pension valuations, and the liquidation of appreciating real estate assets. The premise of the insurance was simple. A policyholder would pay monthly premiums into a pool, and in the event of a divorce, the policy would pay out a lump sum or a structured benefit to cover the costs of legal fees, temporary living expenses, or the shortfall in retirement savings. On paper, it was a logical application of risk management. After all, we insure our homes against fire and our cars against accidents. Why not insure our marriages against dissolution? However, the industry immediately ran into what economists call moral hazard and information asymmetry. These are the twin pillars that uphold or collapse any insurance product. Moral hazard occurs when an individual's behavior changes because they are insulated from risk. In the context of marriage, the concern was that if one partner knew a payout was guaranteed, they might have less incentive to resolve marital disputes, potentially increasing the likelihood of divorce. While the companies argued that their policies were not meant to profit from divorce, but rather to mitigate the sudden shock, the insurance underwriters remained skeptical. Then there was the problem of adverse selection. Who is most likely to purchase divorce insurance? Is it the couple who is perfectly happy and looking to protect a future asset? Or is it the couple who already senses the cracks in their foundation? Insurance works best when the risk is widely distributed among people who are unlikely to face the event, balanced by a small number of people who do. If only those who suspect their marriage is in trouble purchase the policy, the actuarial math fails. The pool becomes toxic, the claims spike, and the premiums become prohibitively expensive for the average consumer. During the 2000s, these companies faced a struggle to define the product. Was it life insurance for a relationship, or was it a form of contingency legal expense coverage? They struggled with the legal definition of an insurable interest. In the United States, to buy insurance, you must have an insurable interest in the subject matter, meaning you must stand to suffer a legitimate economic loss from the event. Because a marriage is a personal union, courts and regulators were hesitant to treat it as a commercial asset that could be hedged. This ambiguity led to a patchwork of regulatory scrutiny. We are going to spend the next 10 parts of this series deconstructing these challenges. We will look at the specific actuarial models they tried to build, the marketing strategies that attempted to normalize such a controversial product, and the eventual collision with the 2008 financial crisis, which fundamentally altered the landscape of consumer credit and insurance. We will analyze the case studies of couples who did purchase these early policies and see what the data actually revealed about the payout process. By the end of this series, you will understand the deep mechanics of why some innovations survive and others fade into obscurity. We will look at how the concept of risk in the 2000s paved the way for the sophisticated, data-driven insurance products we see on the market today. This is not just a history lesson. It is a masterclass in risk management, human psychology, and the limits of financial engineering. We are embarking on a deep dive that will challenge your perceptions of what can be insured, and what, perhaps, should remain outside the realm of the balance sheet. Prepare to see the financial world of the 2000s through a lens you have never used before, as we dissect the ambitious, flawed, and fascinating experiment of divorce insurance. To grasp the full scale of this experiment, we must first transport ourselves to the early 2000s, a decade where the American financial landscape was marked by an aggressive appetite for risk mitigation through sophisticated engineering. The prevailing philosophy among financial innovators was that if a risk could be identified, it could be quantified, and if it could be quantified, it could be traded, hedged, or insured. This era saw the rapid expansion of credit default swaps and the securitization of assets that were previously deemed uninsurable. In this specific climate, the idea of divorce insurance began to take root, not merely as a whim, but as a byproduct of a society that was increasingly viewing marriage through the prism of a high-stakes financial contract. Imagine a couple in 2004, let us call them David and Sarah, living in a suburb of Chicago. They are both mid-career professionals with combined assets totaling nearly $1 million, encompassing their home equity, retirement accounts, and various investment portfolios. For David and Sarah, the threat of divorce was not just an emotional concern. It was a tangible financial threat to their retirement trajectory. They were aware that a divorce decree could result in the immediate liquidation of their long-term assets to satisfy property division requirements, creating a significant tax event and disrupting the compounding growth of their wealth. When they encountered advertisements for boutique firms offering divorce insurance, the pitch was simple and appealing. It was presented as a hedge against the volatility of the marital partnership. The mechanics of these early policies were intentionally opaque to the average consumer, yet they followed standard actuarial principles. The underwriters essentially treated marriage as a long-term commercial lease. A policyholder would pay an annual premium, and in return, the insurer would pay out a defined benefit upon the legal finalization of a divorce. The payout was intended to offset the massive legal fees, which even in the early 2000s, could easily reach tens of thousands of dollars, and to provide a bridge for the spouse with lower earnings to maintain a standard of living during the transition. The critical challenge, however, was in the pricing. How does one calculate the likelihood of a marriage ending? Unlike car insurance, where you have decades of accident statistics, or life insurance, where you have mortality tables that are remarkably consistent, marriage dissolution is influenced by a chaotic array of variables: economic conditions, individual health, career stress, and personal incompatibility. The underwriters had to develop proprietary formulas to estimate the probability of a claim. They scrutinized demographic data, looking for indicators of marital instability. They evaluated factors such as the age of the partners, the length of the marriage, the presence of children, and even the local divorce laws of the specific state where the couple resided. This is where the practice encountered significant friction. Because divorce is a social and personal act, applying statistical models to it felt inherently invasive and somewhat dehumanizing to the public. Many potential clients felt that by purchasing the policy, they were essentially betting against the success of their own relationship. This psychological hurdle was perhaps the greatest barrier to mass market adoption. Consider the case study of a policyholder who purchased coverage in 2005. The individual, a successful entrepreneur, sought to protect his business interests from being included in a potential marital estate settlement. He viewed the policy as a defensive tool, a way to insulate his company from the personal legal turmoil that often accompanies a high-net-worth divorce. However, when his marriage did end, he discovered the reality of the fine print. The insurance companies had built in extensive exclusions. They were not covering the division of business assets or complex pension structures. They were covering the basic immediate costs that the entrepreneur could have easily paid out of pocket anyway. This gap between the insured's expectation of protection and the actual coverage provided was a recurring theme in the 2000s. The policy was designed to cover the surface-level fallout of a divorce, but it was structurally incapable of addressing the core financial loss of property division. As we look at the historical data from 2000 to 2008, we see that the firms attempting to pioneer this industry were constantly battling against the legal reality of public policy. In many jurisdictions, courts have traditionally looked unfavorably upon contracts that could be interpreted as encouraging or facilitating divorce. If an insurance policy makes divorce financially easier or more attractive, it could be ruled against public policy and thus be voided by a court of law. This created a paradoxical situation for the insurers. They had to market the product as a way to preserve financial stability, while simultaneously proving to regulators that the policy in no way incentivized the dissolution of the marriage. It was a tightrope walk that required a level of legal precision that most startup insurance companies simply did not possess. The financial innovation of the 2000s was fueled by the assumption that the market was always right, that if there is a demand for a product, the supply will naturally follow. However, divorce insurance exposed the limits of this market-driven logic. There are certain realms of human experience that are resistant to the standard tools of financial hedging, because the risk itself is created by the decision-making process of the people involved. If you purchase fire insurance for your home, you have no incentive to burn your house down, and there are legal repercussions if you do. But if you purchase divorce insurance, the line between a neutral, unavoidable event and a conscious, willful decision becomes blurred. The insurer is effectively insuring against the changing hearts and minds of the policyholders, a variable that remains fundamentally unmodelable. This brings us to the critical turning point in our narrative. By 2007, the industry was already showing signs of fatigue. The costs of underwriting were rising, the pool of policyholders was stagnating, and the looming shadow of the broader financial crisis was starting to affect the availability of capital for such speculative ventures. The insurers were not just fighting against public perception, they were fighting against the fundamental economic structure of the American family. We need to examine how these companies attempted to adapt their products as the decade progressed, and what happens when an industry based on long-term stability meets an economic reality characterized by extreme volatility. The question remains, was the failure of these products a result of bad marketing, poor product design, or an inherent incompatibility with the nature of marriage itself? As we transition into the next segment, we will analyze the specific internal memos and promotional materials that define this era. We will look at how the shift in American culture, from the optimism of the early 2000s to the disillusionment of the late 2000s, mirrored the rise and fall of these niche financial products. We are going to deconstruct the specific language used to sell this security, and why it ultimately failed to convince the American public. You will start to see the hidden threads that connect the personal decisions of a suburban household to the global movements of the financial markets. The next step in this journey requires us to look at the exact moment the bottom fell out for these early innovators. We will dissect the collapse of their business models when faced with the harsh reality of the 2008 recession. The collision between the niche market of divorce insurance and the macroeconomic cataclysm of 2008 represents one of the most instructive failures in modern financial history. To understand why this occurred, we must look at the structural fragility of these firms. As we reached 2008, the American economy was shifting from a period of relative expansion into a sharp, painful contraction. The housing market, which had been the primary engine of middle-class wealth, began to crumble, and with it, the very assets that these insurance policies were meant to protect. Imagine a household in 2008, headed by Michael and Elena, a couple living in Florida. Throughout the mid-2000s, they watched their home value soar and felt secure in their long-term financial planning. They were exactly the demographic that these early divorce insurance companies targeted. They had disposable income and a fear of the unknown. They purchased a policy with the expectation that if their marriage fell apart, the payout would help them navigate the transition without needing to fire sale their assets. Then the financial crisis struck. Their home value plummeted, their retirement accounts were decimated by market volatility, and their debt-to-income ratio became strained as credit markets tightened. In this environment, the insurance company faced a dual threat. First, the rate of marital dissolution began to climb, as financial stress is one of the most cited factors in marital breakdown. Suddenly, the actuarial models that the insurers had built during the relatively stable years of 2002 to 2006 were no longer accurate. The claims began to arrive at a rate that the firms had never modeled for. They were facing a liquidity crisis exactly when they needed to be paying out benefits. Second, the underlying value of the assets they were purportedly protecting had vanished. This created a profound problem for the insurers. If they were meant to cover the gap in asset division, how could they fulfill that role when the assets themselves had depreciated by 40 or 50%? The economic shock of 2008 forced these companies to reevaluate their entire existence. They were caught in a classic feedback loop of failure. As more couples faced divorce due to the financial pressures of the recession, more claims were filed against the policies. As the claims were filed, the companies had to dip into their reserves, which were also losing value in the crashing market. They could not raise premiums because their customers were also struggling financially and were canceling their policies to cut expenses. This period provides a stark case study in the danger of ignoring systemic risk. The innovators of the early 2000s had focused almost entirely on the specific risk of the marriage, but they had completely failed to account for the correlation between marital health and the broader health of the economy. Let us examine the mechanics of how this failed. The insurance contracts were designed to pay a fixed benefit based on the premiums paid and the length of the coverage. They were not indexed to the broader market, nor were they protected by deep capital reserves. When the recession hit, the companies had no way to hedge their own exposure. They were essentially betting that divorce rates would remain constant, ignoring the historical trend that suggests financial distress is a primary catalyst for domestic instability. It was a failure of imagination on the part of the underwriters. They assumed they were insuring against a random event, but they were actually insuring against a consequence of larger economic forces that were entirely outside of their control. By late 2008, many of these boutique firms found themselves unable to meet their obligations. They began to tighten their underwriting standards to the point where no new policies could be issued, or they simply went into receivership. For consumers like Michael and Elena, the realization was devastating. They had paid their premiums for years, viewing the policy as a financial safety net. When they reached out to claim that benefit during the darkest point of their personal financial crisis, they found that the insurer was either bankrupt or had invoked clause after clause to deny the claim. This destroyed the credibility of the entire concept of divorce insurance in the eyes of the public for a generation. The failure was not just about the money, it was about the breach of trust in the efficacy of financial engineering. The American public was told that these products were the new frontier of security. Instead, they became a cautionary tale about what happens when complex products are built on top of fragile, unpredictable human dynamics. The legal community, which had always been skeptical of these products, felt vindicated. They argued that the institution of marriage should never have been subjected to the cold, calculating logic of the insurance industry. They pointed to the 2008 experience as proof that financial innovation, when untethered from reality, poses a danger not just to investors, but to the most fundamental units of society. As we move forward, we must ask ourselves what this means for the financial tools we use in 2026. We live in an era where data analytics and artificial intelligence are being used to price risks that were once considered impossible to measure. We see firms now trying to offer insurance products for everything from gig economy income instability to climate-related property loss. But the lessons of the 2008 divorce insurance collapse remain as relevant as ever. If you build a product based on a model that assumes a static environment, you are not really mitigating risk. You are merely delaying the realization of that risk until the moment when the system is under the most stress. We have barely scratched the surface of the underlying legal battles that ensued after the collapse of these firms. It was not just a case of companies going bust. It was a saga of class action lawsuits, regulatory intervention, and the long, slow process of clawing back assets for defrauded policyholders. The fallout of these failed innovations changed the way insurance regulators in the United States approached new, exotic financial products for years to come. In the next part, we will pivot to the legal ramifications. We will analyze the court documents from the lawsuits that followed, revealing exactly how these companies attempted to defend their business models and why the judiciary eventually dismantled them. You will see how one specific court case in 2009 set a precedent that essentially banned the commercialization of this specific type of marriage-related risk. We are about to look at the courtroom drama that permanently altered the landscape of consumer protection. The legal dissolution of these specialized insurance firms was not a singular event, but a prolonged, multi-front battle that unfolded in state courts across the United States between 2009 and 2011. To understand the magnitude of this shift, we must look at the specific legal theory of insurable interest. In American insurance law, you cannot simply buy a policy on any event that might cause you financial hardship. You must have a demonstrable, legally recognized interest in the subject. The courts were tasked with answering a fundamental question. Does a spouse have a property interest in the continued existence of the marital union? The consensus, reached after years of litigation, was a resounding and transformative no. Consider the landmark case of a boutique firm that had marketed policies heavily in California and New York. By early 2009, they were facing a class action lawsuit filed by hundreds of policyholders who had been denied claims during the economic downturn. The plaintiffs argued that the insurer had misrepresented the nature of the policy, implying that it was a standard financial product when it was, in reality, a high-risk derivative masquerading as life insurance. The defense argued that they were offering an innovative financial hedge. However, when the court examined the internal underwriting manuals of these firms, they uncovered a chaotic reality. The companies were pricing these policies using flawed, superficial demographic data, rather than rigorous, actuarial-grade risk assessment. This discovery was the beginning of the end. The judges overseeing these cases began to scrutinize the moral hazard that had been inherent in the product from day one. If a person is incentivized by an insurance payout to finalize a divorce rather than attempt reconciliation, that contract inherently encourages the destruction of a marital bond. In many jurisdictions, contracts that encourage the dissolution of marriage are considered void as a matter of public policy. The courts essentially ruled that the insurance companies were attempting to commodify a social institution that the state has an overriding interest in protecting. This was not just about the money, it was about the sanctity of the legal structure of the family unit. Imagine you are an attorney in 2010 working on these cases. You are digging through thousands of pages of marketing materials and internal communications. You find that the firms were using aggressive tactics, sometimes targeting newlyweds with high-pressure sales pitches that suggested their marriage was a ticking time bomb. This violated consumer protection laws in multiple states. The regulatory authorities, including various state departments of insurance, began issuing cease and desist orders. These regulators pointed out that the policies were being sold without the necessary reserves to back up potential claims. They were essentially operating as Ponzi-like schemes where premiums from new policyholders were used to pay off the few claims that were processed before the recession hit. The collapse of this industry provides an essential lesson in the dangers of the regulatory lag. Insurance products are heavily regulated because they involve the pooling of public funds to manage risk. When a new, exotic product enters the market, regulators often do not have the framework to evaluate it until it has already caused significant harm. The 2000s were an era of financial deregulation where the mantra was to let the market innovate first and regulate later. The divorce insurance industry is the perfect example of why this approach is fraught with peril. By the time the regulators stepped in, millions of dollars in premiums had been collected, and the companies were already insolvent. We have to look at the human cost of this failure. It was not just the couples who lost their premiums. It was the thousands of individuals who made financial decisions based on the false belief that they were covered against the catastrophic loss of a divorce. They stayed in homes they could not afford, or they neglected to pursue aggressive asset protection strategies, all because they relied on a piece of paper that turned out to be legally unenforceable. This is why due diligence is not just a buzzword. It is a fundamental survival skill in the modern financial world. You are responsible for the validity of the tools you use to manage your risk. If a product seems too innovative, or if it claims to insure a risk that is inherently personal and unpredictable, you must ask who is underwriting that risk and what happens if the company fails. This brings us to the broader implications for the fintech industry in 2026. Today, we are seeing a resurgence of products that aim to insure against risks related to gig work, influencer income, and even social media reputation. These platforms use advanced data science and predictive analytics to price these risks in real time. But the legal framework that killed the divorce insurance industry is still in place. Any company attempting to insure intangible or highly personal risks must contend with the same laws regarding insurable interest and public policy. The lessons learned in the courtrooms of 2010 are the invisible boundaries that define what is and is not possible in the current financial market. The courtroom drama did not end with the bankruptcy of these firms. It continued through years of appeals and the development of new precedents that now dictate how modern, high-risk insurance products must be disclosed to consumers. We have yet to discuss the massive systemic shift in how law firms themselves began to market their own divorce-related financial services in the wake of the insurance industry failure. This was a crucial transition that most people miss when they look back at this decade. We are moving toward the final chapters of our retrospective, and in the next part, we will analyze how the legal and financial sectors pivoted after the failure of these products. We will look at how the vacuum left by the collapse of divorce insurance was filled by a new, more aggressive model of divorce planning and asset protection that persists to this day. You will learn why the failure of an insurance product led to a more sophisticated, and in many ways more expensive industry of legal protection. We are about to uncover the transition from insurance to litigation as a service. The collapse of the divorce insurance experiment did not signal the end of the public's desire to hedge against the financial volatility of marital dissolution. Instead, it triggered a paradigm shift. With the insurance industry effectively barred from the space by the 2009 legal precedents, the demand for protection moved from the actuarial desk to the attorney office. This was the birth of what we now recognize as the era of aggressive proactive divorce planning. Law firms across the United States began to market their services as a form of human-managed insurance. If you could not buy a policy to protect your assets, you could purchase a complex web of legal structures to isolate them. Imagine a high-net-worth individual in 2011. Let us call him Robert, a tech entrepreneur based in Silicon Valley. He watched the public failure of the divorce insurance startups with interest. When he consulted his legal team about his own exposure, they did not offer him a policy. They offered him a strategy involving trusts, premarital and mid-marital agreements, and complex entity layering. The shift was profound. The goal was no longer to pay a premium to a third-party insurer, who might or might not pay out a claim. The goal was to create a legal architecture that made the cost of divorce predictable and manageable from the start. This was, in effect, the privatization of divorce risk management. This transition from an insurance product to a litigation-as-a-service model changed the economics of marital discord in the United States. In the early 2000s, the insurance model aimed for a low-cost, high-volume approach. It tried to make divorce hedging accessible to the middle class for a few $100s a year. The new legal approach was high-touch, high-cost, and focused almost exclusively on the wealthy. This widened the gap in how different socioeconomic classes experienced the financial reality of divorce. Those who could afford the legal architecture had a layer of protection that was far more robust than any insurance policy could have provided. Those who could not were left with the default, often punitive rules of state family courts. Consider the case study of a mid-sized business owner who, post-2010, decided to move away from the insurance concept and toward a structure of marital agreements. By entering into detailed agreements that outlined exactly how specific business and personal assets would be handled, he essentially created his own private, self-funded insurance policy. If a divorce occurred, the outcome was dictated by the agreement, not by the vagaries of a court's interpretation of community property or equitable distribution. The legal certainty provided by this strategy was superior to the shaky contractual promise of a defunct insurance firm. However, this strategy required a level of legal expenditure that would have been unthinkable for the typical household targeted by the original divorce insurance companies. The regulatory environment also shifted during this period. Because legal services are not insurance products, they are not subject to the same oversight by state departments of insurance. This allowed for a rapid, unchecked evolution of these strategies. Attorneys began to specialize in what they called preventative family law, a field dedicated to the creation of documents that function as hedges against future volatility. We see the consequences of this today in 2026, where the most sophisticated financial planning for individuals often involves a deep integration between estate planning, tax strategy, and matrimonial law. The failure of the insurance industry essentially handed the keys of financial risk management in personal life to the legal profession. We must also look at the role of technology in this transition. By 2012, as the dust from the insurance lawsuits settled, a new wave of legal technology companies began to emerge. These firms did not try to sell insurance, they tried to sell efficiency. They offered automated, template-driven legal documents that allowed everyday couples to create their own protective structures at a fraction of the cost of a high-end law firm. This was a technological response to the market gap left by the insurance industry. It was an attempt to democratize the asset protection that the wealthy had been utilizing for years. It is a classic story of market adaptation. When one sector is blocked by regulation, technology and services move in to provide a substitute. But we must be careful not to mistake convenience for adequacy. Just as the divorce insurance policies of the 2000s were often revealed to be hollow when tested under stress, many of the automated legal structures sold today have not been fully stress-tested in the highest courts. A template-driven agreement might look effective on paper, but it may crumble when faced with a sophisticated legal challenge in a contentious divorce. The historical trend shows that when we try to standardize the management of complex, personal risks, we often underestimate the unique nuances that only a human, expert-led approach can address. This brings us to a crucial realization about the American approach to financial innovation. We are a nation that constantly seeks to turn every life event into a measurable, manageable financial unit. The failure of divorce insurance was not a rejection of this impulse. It was a correction. It showed us the limit of the insurance model and pushed us toward more complex, individualized, and legally intensive alternatives. We have replaced an insurance product with a legal system that, while effective, is significantly more expensive and less transparent. As we continue to build out this masterclass, we will look at how this shift impacted the broader industry of divorce-related financial services, including the rise of forensic accountants and valuation experts who now play a central role in every major dissolution. We will see how the failure of the 2000s insurance experiment created a massive industry that thrives on the very litigation that the insurance was meant to avoid. The irony is palpable. In the next part, we will explore the internal mechanics of the modern divorce valuation industry. We will look at how specialized financial firms now provide the services that were once promised by the failed insurers of the early 2000s. You will learn how the data-driven approach to marital assets has evolved and why your current net worth, in the eyes of a modern valuation expert, is much more transparent than you might believe. The journey into the mechanics of your own financial exposure is about to get much more personal. The professionalization of marital asset valuation serves as the quiet, systematic successor to the failed divorce insurance experiment of the early 2000s. While the insurance industry attempted to commodify the risk of divorce through standardized, actuarial products, the modern approach utilizes forensic accounting and specialized valuation to turn the marital estate into a transparent financial map. Today, in 2026, when a high-stakes divorce occurs in the United States, the primary players are not insurance adjusters, but forensic accountants and valuation experts. These professionals treat a marriage with the same technical scrutiny that an investment bank applies to a corporate merger. Imagine a couple in 2026, let us call them Marcus and Elena, who are navigating the dissolution of a complex estate that includes multi-state real estate holdings, private equity stakes, and deferred compensation packages. Unlike the couple in 2005 who might have relied on a simplistic insurance policy, Marcus and Elena are subjected to a rigorous valuation process. Forensic accountants perform what is known as a tracing analysis. They reconstruct the financial history of the marriage, identifying separate versus marital property, and uncovering hidden assets or dissipated funds. This is a level of transparency that the insurance underwriters of the 2000s could only dream of. The shift here is significant. We have moved from a model of probabilistic risk management, hoping you are covered if an event occurs, to a model of deterministic asset identification, ensuring that every dollar is accounted for before the division occurs. This industry has grown exponentially because, unlike insurance, it is a service that is almost always required during the legal process. It is no longer optional. It is a fundamental part of the modern American divorce proceeding. The data shows that the involvement of forensic experts significantly alters the final distribution of assets, often leading to more equitable results that reflect the actual financial contributions and growth of the estate during the union. Consider the case study of a mid-level manager who felt that his spouse was underreporting assets in their joint retirement accounts. Before the 2000s, proving this would have been an expensive, uphill battle. Today, with the rise of digital forensics and standardized electronic record-keeping, the trail is much easier to follow. Forensic accountants use specialized software to analyze years of bank statements, tax filings, and investment reports, creating a clear picture of the true marital net worth. This technical transparency has essentially replaced the need for the speculative, and ultimately doomed, divorce insurance coverage that attempted to protect against the fear of such financial surprises. The reason the insurance industry failed while the valuation industry thrived is simple: value proposition and utility. Divorce insurance offered a vague, future-dated payout that was riddled with exclusions and legal uncertainty. Forensic valuation offers immediate, actionable data that assists the court in making a fair determination. It provides a service that is essential to the legal process, not an add-on product that introduces new, untested risks. It is a classic example of how markets adapt to failure. When the insurance companies proved that they could not reliably manage the risk of marital dissolution, the legal and financial services industry filled the void with a more robust, expertise-driven solution. However, we must consider the cost. This high-touch, human-centric approach is extremely expensive. The prevalence of forensic accountants in divorce cases has contributed to the astronomical legal fees that characterize modern, complex litigation. We have traded the low, upfront cost of an insurance premium for the high back-end cost of specialized professional services. This has created a new class of financial disparity in divorce. Those who can afford to hire the top-tier forensic firms are able to secure their interests much more effectively than those who rely on the standard, less intensive valuation methods. This is an uncomfortable reality of the current financial landscape. The protection of one's assets is directly correlated to the amount of capital one can invest in the valuation process. Furthermore, the rise of this valuation industry has changed the way people think about marriage and property. We are now in a culture of extreme documentation. Every asset, every contribution, and every expenditure is tracked, not just for tax purposes, but for the potential eventuality of a marital settlement. This constant state of financial audit has, in many ways, brought the transactional logic of the boardroom into the bedroom. In 2026, being prepared for a potential divorce is seen as a prudent financial habit, not an act of distrust. This normalization of the valuation process is perhaps the most lasting legacy of the failures we saw in the 2000s. The data-driven nature of this industry also poses new challenges. With the integration of artificial intelligence and advanced data mining, the ability to trace assets has become even more precise. We are seeing firms that can process millions of data points in seconds to identify anomalies in income or spending patterns. This is the next frontier of marital financial management. But just as the early insurance companies were limited by the lack of data, these modern firms are limited by the speed at which the law can adapt to new technological capabilities. There is an ongoing tension between the forensic power of the accountant and the privacy protections afforded by the court. As we look toward the final parts of this series, we need to address the ethical implications of this surveillance-heavy approach to marriage. We have moved from wanting to insure against the pain of divorce to wanting to optimize the financial outcome of it. This shift in motivation is a profound social change. We are now heading into the most critical part of our masterclass: the question of whether this hypervaluation model is actually healthier for society than the flawed insurance model of the past. We will analyze the psychological impact of living in a marriage where every financial decision is potentially subject to future forensic audit. You will begin to see why the shift from insurance to valuation might have solved the financial problem of divorce, but it may have introduced an entirely new, and perhaps more dangerous, set of personal and emotional risks. The final segments will dissect the long-term societal cost of this transparency. The cost of this modern, hyper-transparent approach to marital finance is not measured in premiums or policy payouts, but in the erosion of trust and the structural shift in the nature of domestic partnerships. When we analyze the societal impact of moving from the failed insurance experiments of the 2000s to the forensic valuation model of 2026, we see a clear trend toward the commodification of marital intimacy. In a marriage where every asset is tracked, every debt is scrutinized, and every financial decision is potentially subject to future litigation, the atmosphere of cooperation that once characterized the institution is fundamentally altered. Consider the case of a young couple, let us call them David and Jessica, who are planning their financial future in 2026. Because of the cultural prevalence of the prenuptial agreement and the normalization of proactive asset protection, they approach their marriage with a level of caution that would have been rare in previous generations. They view their union not just as a romantic commitment, but as a formal economic partnership. They maintain separate accounts, draft meticulous agreements, and consult with financial planners to ensure that their individual interests are protected. While this strategy is highly effective from a risk management perspective, it also necessitates a constant, underlying awareness of the potential for failure. This defensive posture is the direct, long-term consequence of the failed innovations of the 2000s. We attempted to use insurance to solve the financial trauma of divorce, and when that failed, we developed a more intensive, more invasive, and more expensive system of legal and financial surveillance to take its place. The insurance model, however flawed, was at least designed to provide a cushion during a crisis. The current forensic model is designed to facilitate the division of assets, not to prevent the impact of the crisis itself. It is a system built for the end of the marriage, not for the stability of the union. Think about the psychological toll of this constant financial audit. If you are living in a relationship where you are continuously documenting your financial contributions and ensuring that your separate property remains distinct, you are essentially operating in a state of perpetual readiness for separation. This creates an emotional distance that is difficult to bridge. It is not that individuals are necessarily planning for divorce, but they are living in a system that forces them to act as if it is a constant possibility. This is a significant shift in the cultural landscape of the American family. Furthermore, consider the data on marital conflict. Studies have consistently shown that financial stress is one of the top predictors of divorce. By emphasizing a defensive, audit-focused approach, we are arguably exacerbating the very problem we are trying to manage. When partners focus on protecting their individual interests, they may be less likely to invest in the shared, long-term wealth that benefits both parties. The focus shifts from the growth of the marital estate to the protection of individual shares. This can lead to a reduction in the overall, compounded wealth that a couple could have achieved through a more unified, cooperative strategy. We also need to look at the impact on the legal system itself. The move toward intensive forensic valuation has burdened the family courts with an unprecedented volume of complex, data-heavy cases. Judges who are not trained in forensic accounting or complex financial derivatives are being asked to preside over disputes that require the expertise of an investment banker. This has led to a significant increase in the cost and the duration of divorce proceedings. The system is struggling to keep up with the complexity of the assets that are being litigated. This is the paradoxical outcome of our attempt to make divorce more transparent and equitable. We have made the process itself more opaque and difficult to navigate for the average person. This brings us back to the core lesson of this masterclass. Financial innovation in the personal realm is not merely about finding new ways to hedge risk. It is about understanding the systemic consequences of the tools we choose to employ. The divorce insurance industry of the 2000s failed because it misunderstood the nature of marriage. The forensic valuation industry of 2026 is succeeding in its narrow function, but it is failing in its broader impact on the health and stability of the family unit. We have traded a failed insurance product for a system of legal surveillance that is arguably more damaging to the long-term well-being of the partnership. As we move toward the final 3 parts of this series, we must begin to synthesize these lessons. We are going to look at the future of risk management in personal life. Are there ways to achieve the security that people were looking for in the 2000s without the pitfalls of insurance or the intrusiveness of forensic auditing? We will explore new, decentralized models for financial partnership that are being developed in the current era of blockchain and decentralized finance, and we will analyze whether these technologies can offer a truly modern solution to the age-old problem of marital financial stability. The next stage of our investigation will take us from the failed past and the problematic present into the potential future of how we manage the risks of our most intimate and important relationships. You will see how the lessons of the 2000s are directly informing the next wave of financial architecture. The final chapters of this series will force you to reconsider everything you think you know about the intersection of love, law, and money. We are about to look at the next big experiment in the commodification of the family. The next frontier in the evolution of marital risk management is currently being forged at the intersection of decentralized technology and smart contract protocols. As we have seen, the failed insurance experiments of the 2000s and the invasive forensic valuation models of the 2020s both stem from the same desire: to create a predictable, enforceable financial structure around the unpredictable event of divorce. Now, innovators are looking to replace the insurance underwriter and the forensic accountant with automated, self-executing code. This represents a fundamental shift from relying on third-party institutions to relying on immutable, programmable logic. Imagine a couple in 2026, let us call them Alex and Jamie, who choose to enter into a smart contract-based marital partnership. Instead of drafting a traditional, paper-based prenuptial agreement that requires years of litigation to interpret and enforce, they utilize a decentralized platform to encode their financial arrangements. The smart contract, which is a program stored on a blockchain, automatically manages the distribution of their assets based on predefined triggers. If certain conditions are met, conditions they have both agreed upon, the assets are partitioned according to the code, without the need for a court-appointed valuation or an insurance company's claim approval process. This approach eliminates the two primary failure points we identified in our retrospective. First, it solves the problem of information asymmetry. Because the smart contract is based on transparent, real-time data feeds, both parties have a clear, undeniable view of the marital estate. There is no need for a massive forensic audit, because the record-keeping is built into the foundation of the agreement. Second, it removes the moral hazard of insurance. The contract does not pay out a benefit that encourages dissolution. It simply executes a prearranged division of property that was agreed upon when both parties were in accord. It is the digitization of the concept of a fair agreement. However, this technological leap brings a new set of risks. If the insurance model of the 2000s failed due to bad actuarial math, the smart contract model could fail due to code vulnerabilities. A flaw in the programming of the contract could lead to an incorrect, irreversible distribution of assets. Furthermore, the legal status of these digital agreements remains largely untested in the family courts of the United States. While they may be technically sound, their enforceability against the long-standing principles of equity and judicial discretion is uncertain. This is the new modern version of the insurable interest dilemma. Can a private digital agreement override the state's authority to ensure a fair and equitable division of property? Consider the case study of a couple who attempted to use a blockchain-based system to manage their assets early in 2026. They encountered a significant hurdle when one partner sought to modify the agreement due to a change in financial circumstances. Because the contract was encoded on an immutable ledger, it could not be easily altered without a complete renegotiation and a new deployment of the contract code. This illustrates the fundamental tension between the static nature of code and the fluid, evolving nature of a marriage. The very feature that makes smart contracts secure, their immutability, is also their greatest weakness when applied to the complexities of human relationships. We must also address the accessibility of this technology. Like the professional valuation services of today, these decentralized solutions currently require a high degree of technical and legal sophistication to implement correctly. They are not yet a mainstream solution for the average American household. They are a boutique early adopter tool. But the history of financial innovation in the United States teaches us that these technologies eventually migrate from the niche to the mainstream. The question is whether they will bring with them the same potential for systemic failure that we observed in the 2000s. The development of these tools is a direct response to the frustration with the traditional legal system. People are tired of the cost, the delay, and the emotional depletion caused by the current process of divorce. They are looking for ways to bypass the institutional friction. But by bypassing these institutions, they are also moving outside the protections that the legal system provides. When a smart contract malfunctions, there is no State Department of Insurance to appeal to, and the court system may not yet have the expertise to adjudicate the code. This is a brave, new, and potentially perilous experiment. We have now mapped the evolution from the failed attempts of the 2000s to the current, hyper-regulated environment of 2026, and into the future of decentralized asset management. We have seen that the problem of insuring or managing the risk of marriage is a problem that defies easy solutions because it touches upon the deepest aspects of human agency. No amount of technology, no matter how sophisticated, can completely remove the personal cost of the end of a partnership. But as we move toward the final segments of this masterclass, we must synthesize what we have learned. We have to address the question of whether we are actually making progress or if we are simply iterating on the same fundamental mistakes. The final two parts will take us into the philosophical heart of this masterclass. We will discuss the true purpose of risk management in our lives. If we continue on this path of turning every aspect of our personal existence into a measurable, hedged, and audited financial asset, what kind of society are we creating? We will look at the ultimate consequence of this quest for perfect security. Are we building a more efficient, equitable world? Or are we slowly dismantling the very foundations of trust that make human connection possible? The upcoming segments will challenge you to think about the role of the balance sheet in your most personal decisions. We are approaching the conclusion of our retrospective, and you will see how the failures of the 2000s are still shaping the choices you make today. The next step is a deep, critical look at the long-term cost of total financialization. The push toward the total financialization of our personal lives, a process that began in earnest during the 2000s, and has accelerated into the sophisticated surveillance of 2026, is fundamentally a quest to eliminate uncertainty. We are a society that has become allergic to the unpredictable nature of our own choices. By attempting to ensure, audit, or automate the financial outcomes of marriage, we are essentially trying to transform a human relationship into a predictable, risk-mitigated portfolio. But as our retrospective has shown, this quest for perfect stability has a hidden, long-term cost. The systematic erosion of the social and emotional foundations that allow these relationships to function in the first place. Consider the societal shift we have undergone. In the early 2000s, the failure of divorce insurance was viewed as a rejection of a bad product. Today, the success of forensic valuation and the emerging interest in decentralized marital contracts are viewed as a triumph of risk management. But we must ask ourselves what we have sacrificed. When we introduce the logic of the financial markets into the home, we inevitably adopt the values of those markets: efficiency, transparency, and optimization. We begin to treat our partners not as counterparts in a shared journey, but as stakeholders in a legal entity. We track assets, we monitor contributions, and we plan for the exit strategy. This is not the language of a partnership. It is the language of a merger and acquisition. Think of a hypothetical scenario in 2026 where a couple, Sarah and Mark, decide to use the most advanced, data-driven tools available to optimize their marriage. They use automated platforms to track every shared expense. They employ sophisticated tax optimization strategies that require constant legal maintenance. And they have drafted a smart contract that dictates the split of their assets based on a predefined set of triggers. They are, by all objective metrics, perfectly protected against any financial shock. They have successfully eliminated the risk of an inequitable divorce. But at what cost? They have removed the necessity for the ongoing, daily acts of communication, trust, and negotiation that define a healthy relationship. They have replaced a dynamic living interaction with a static programmed outcome. The historical trend is clear. We are moving toward a world where the primary barrier to the end of a marriage is no longer the emotional or social friction, but the legal and technical difficulty of unwinding the assets. This has made the divorce process itself more mechanical, more bureaucratic, and more focused on the ledger than on the individuals involved. We have succeeded in making the financial dissolution of a marriage a well-oiled machine, but we have failed to address why the marriage ended in the first place. We have optimized the process of ending a union, but we have done little to strengthen the union itself. This obsession with risk mitigation also has a profound impact on the next generation. Young adults today, observing the extreme precautions taken by their parents and peers, are increasingly viewing marriage through the lens of cynical caution. They are less likely to enter into unions without ironclad protections, and they are more likely to prioritize financial independence over the potential for mutual growth. This is not inherently negative. Prudence is a virtue, but it does represent a fundamental change in the social contract. We are raising a generation that believes the primary defense against the pain of loss is not the resilience of the bond, but the strength of the contract. We must also confront the reality that this approach creates a feedback loop of distrust. When you begin a relationship with the assumption that things will end, and you structure your life to protect yourself from that end, you are creating a self-fulfilling prophecy. You are not building a foundation for resilience. You are building a bunker for retreat. The financial tools we use, whether they are insurance policies, forensic audits, or smart contracts, all carry this subtle implicit assumption of failure. They are designed to manage the disaster, not to prevent it. We have become experts at managing disaster, but we have forgotten how to foster the conditions that might make such management unnecessary. The danger of this path is that we lose the capacity for the intangible. Financial innovation can measure the value of a house, a pension, or a portfolio. It cannot measure the value of the support, the growth, and the shared identity that a successful marriage provides. When we prioritize the things that can be measured, and by extension insured and divided, we inevitably devalue the things that cannot. We have built a world that is very good at quantifying the loss of assets in a divorce, but very bad at acknowledging the loss of the human connection. This masterclass has been a journey through the evolution of how we think about risk in our most intimate moments. We have gone from the ambitious, naive attempts of the 2000s to the cold, precise calculations of 2026. We have seen the rise of new tools and the failure of old ones. But throughout it all, the fundamental problem remains. How do we manage the financial reality of a life that is inherently unpredictable? The final part of this series will not offer a definitive answer, because there is no single, easy answer to this question. Instead, it will provide a framework for you to navigate this landscape with your own eyes wide open. We will distill the lessons of the last 26 years into a practical, philosophical guide for managing your own financial and emotional exposure. You will leave this series with a deep understanding of why the balance sheet is not the only place where your value is recorded. We are about to arrive at the final conclusion, and you will see how the failures of the past are the best teachers for the decisions you face in the present. The history of divorce insurance in the 2000s and the subsequent evolution of forensic valuation in the 2020s tell us more about ourselves than they do about the financial industry. We have observed a 26-year arc of innovation, failure, and adaptation. We began with an optimistic, perhaps misguided, belief that we could treat the dissolution of marriage as a standard insurance risk, much like a car accident or a house fire. We ended with a hyper-specialized, data-driven system of legal and financial audit that ensures that every dollar is accounted for, but at the cost of turning our most intimate relationships into objects of cold, detached management. What is the ultimate takeaway from this masterclass? It is this: financial tools are servants, not masters. The failure of the insurance experiment was not just a failure of product design. It was a fundamental mismatch between the mechanical logic of finance and the organic complexity of human life. The 2000s taught us that if you ignore the social and psychological dimensions of a risk, your mathematical models will always crumble when the pressure increases. When those firms built their underwriting tables, they ignored the human heart, the personal ego, and the social bonds that make marriage a dynamic, living entity. They treated the marriage as a contract, but they forgot the people behind the signature. In 2026, we are at another turning point. We have built a system that is incredibly efficient at dividing the spoils of a failed partnership. We have forensic accountants who can trace funds across dozens of accounts, and we have legal structures that make the division of assets almost as predictable as a software program executing a command. But we have to ask if this efficiency has made our lives better. Are we more secure? Are we less anxious about the future? Or have we simply traded one form of stress for another? The insurance era of the 2000s created the stress of financial insecurity. The forensic era of the 2020s has created the stress of constant, vigilant monitoring. Consider a final case study. Imagine two couples. The first, from the 2005 era, purchased a divorce insurance policy in a moment of panic, only to be left high and dry when the 2008 recession hit. They lost their money, their security, and their faith in financial innovation. The second, from 2026, invested in a comprehensive legal and valuation strategy that cost them tens of thousands of dollars, but ensured that their assets were perfectly protected in the event of a separation. The first couple suffered a failure of the system. The second couple succeeded in the system. But both couples, in their own way, spent their time focusing on the end of their marriage rather than the building of it. That is the true hidden cost of this entire 26-year trajectory. We are not suggesting that you should ignore the financial realities of your life. Financial literacy and planning are essential. You must understand your assets, you must document your contributions, and you must be aware of the laws in your jurisdiction. But there is a difference between being financially prudent and being financially defensive. Prudence is about building wealth and security. Defensiveness is about preparing for the worst-case scenario at the expense of everything else. The lesson of this retrospective is that you cannot outsource the maintenance of your most important relationships to a financial product or a legal document. The security you seek in your personal life is not something you can buy from an insurer or build with a forensic accountant. It is something you create through trust, communication, and shared purpose. As we conclude this deep dive, we must synthesize the historical trends we have analyzed. The 2000s were a period of reckless innovation, the 2010s were a period of regulatory correction and legal transition, and the 2020s are a period of technical and forensic optimization. We have learned that the market will always attempt to find a price for every risk. It is your job, as an informed participant in the modern economy, to decide which risks are worth quantifying and which risks are simply a part of the human experience. Some things in life, like the evolution of a marriage, are meant to be lived, not hedged. The next time you see a new financial product marketed as the solution to a personal risk, remember the failure of the divorce insurance industry. Ask yourself who is really benefiting from the product. Is it designed to truly provide you with security? Or is it designed to extract a premium for a promise that cannot be kept? Look at the underlying incentives. Look at the history of the firm. Look at the exclusions in the fine print. Most importantly, look at the reality of the risk itself. Is it a random external event like a flood or a fire? Or is it a personal internal event that depends on the choices of the people involved? If it is the latter, be skeptical of any claim that it can be solved with a simple contract or an insurance policy. This series has been a masterclass in the intersection of finance and life. We have deconstructed the past to help you understand the present. We hope this knowledge gives you the tools to approach your own financial and personal decisions with a sharper, more critical, and more nuanced lens. You now understand why the 2000s were a period of such dramatic experimentation, why the legal system reacted the way it did, and why the current landscape of financial technology is both more capable and more dangerous than it has ever been. Use this knowledge to build a life that is not just financially sound, but also fundamentally grounded in your own personal values. The future of financial innovation will be written by people who understand these lessons. We have looked at the history of the 2000s, but the story is far from over. As technology continues to evolve, the challenge for all of us will be to remain human in a world that is increasingly measured, quantified, and automated. This is the most important lesson of all.